All right, welcome everyone. My name is Fair Sleem. I am the editor of the Bowser Report. This is going to be the first YouTube video on our channel, actually, and I really wanted to go over the bread and butter of our stock newsletter, the Bowser Game Plan. All right, before we get into that, I will mention, since this is the first video on our YouTube, that the Bowser Report mainly focuses on small cap stocks that are trading under $3 a share, and we focus on long-term investments, right? We've been around for over 40 years. This game plan that we're about to talk about has benefited our subscribers for over 40 years, and we've recommended a lot of winning stocks, all right? So if you're not a subscriber, that's fine. This game plan and the rules and the portfolio management style that we're going to talk about apply to all kinds of investors, right? That's why we're putting this up on YouTube. And if you are a subscriber, right, enjoy it. A lot of you guys are probably already familiar with the game plan, but I think that, text can only take us so far. So a video with visual representation should definitely make the investment process a little bit easier for you. Okay. Now, first things first, right? The Bowser game plan is just a guideline and rules that Max Bowser himself, so the founder of the Bowser Report, created years ago and has tweaked along the way in order to kind of fit our investment style. So if you like a couple of these rules, but you don't necessarily think that they all apply to yours, or if you like the math behind it and you just want to tweak it a little bit to your investment style, that's perfectly fine. What's important and the major takeaway from this video is so that you have a game plan yourself, okay? If you're investing without a plan, you might as well just be throwing darts. All right, so let's get right into it. The first thing that we have here on the Bowser game plan is to not pay more than $3 per share for a stock. And that's something that we've had, for a very long time for the Bowser Report. There are appealing stocks that trade at a higher price. There's no question about it. But the whole point of focusing on stocks that are trading under $3 is that they have more potential upside, right? There's a lot more appeal to them. You get a much better risk to reward. And overall, right, they have a better chance of being discovered. One of the biggest things that drives share price for smaller stocks is when institutions start taking an interest, right? So you don't really see that under $3. You do occasionally, but it's not common, right? And as a stock surpasses $3 and starts to grow and has that potential exponential growth, right, that's where you really start to hit home runs. And I don't really want to emphasize home runs too much. A lot of our investment style and our Bowser game plan focuses on the math behind investing and taking profits on winners and cutting loose losers. Okay, so again, the first thing is don't pay more than $3 per share for a stock, as you're likely overpaying, and you will probably be able to get a cheaper price if you do think that it's an appealing investment. Okay, number two is to create a portfolio of 12 to 18 stocks. All right, 12 to 18 stocks. And this is different for everyone. However, a lot of this game plan you'll probably see, and I'm sure a lot of your current game plan, if you have any structure to your investment style, is done by trial and error, right? It's a result of making mistakes and learning from them. And this is by far one of the most expensive mistakes you will make as an investor if you haven't already. Putting all of your chips in one bag. And it doesn't really benefit anyone. Maybe you'll get rich quick if you just focus on 1 to 2 stocks, but the bottom line is that's not a viable game plan long term. And this goes for any short-term investors too, right? If you're watching this video and you say, well, I guess I go long term, a year, 2 years, you should always try to build your wealth. But if you also focus on short-term investment, you have to diversify. There's no question about it. If you're swing trading, you have to diversify and have multiple holdings, because if one of those 2 stocks that you're holding tanks, you're done. There's no coming back from that. Not everybody is trading with a trust fund over here. You can't just bounce back and deposit money into your account again and pretend like it never happened, right? So the ability to diversify and hold 12 to 18 stocks goes a very long way, because if a couple of your holdings underperform, you really won't take that big of a hit, right? And you might be thinking, well, doesn't that limit my reward as well? Again, the game plan is structured so that you are able to let your winners ride and cut your losers loose. Okay, so in that case, the diversification doesn't really hurt you, it just helps you. Okay, so again, you could see where the diversification is mainly focused on sustainability and having a successful long-term portfolio, right? You've seen this with any hedge fund. You've seen it with any successful money manager. Every single time they diversify one way or another. Okay, so we mainly recommend 12 to 18 stocks just because that's a sweet spot. And based off the number of stocks that we're tracking, that's usually a good area to have that number of holdings. But again, this could be a little bit different based off of what you do personally. Okay, personally, right, my long-term investment portfolio has 14 stocks, just to give you an idea. Okay, 14 stocks. And since we're in a market correction, I was actually 12. Since we're in a market correction, I picked up 2 more that I thought were trading at a discount. Okay, so again, based off the market conditions, this may fluctuate, but that's kind of the sweet spot that you want to aim to be in. Okay. All right. Now, number 3 and actually number 4, we'll talk about these together because, everybody wants to talk about number 5, the selling plan, the exit plan. But number 3 and 4 really are geared towards Bowser Report subscribers because these are questions that we get pretty frequently, right? We try to focus on stocks that are trading between $1 and $3, right, when we recommend them. Now, if a stock goes above $3, we automatically just get this big inflow of emails asking, well, do I sell right now? Do I sell right now? It's above $3, right? I bought under. That's a good thing, right? It is. But the point of long-term investments is not to sell as soon as they become winners, right? In this case, what you do is you would note it and you would track those shares a little bit more carefully and focus on the selling plan, which is number 5, and we'll get to that in a second, okay? So if it crosses above $3, that's not an exit signal. That's more of just a positive sign that the trade is going well, right? That the investment is going well, okay? Now, number 4 says do not sell when a stock moves to a lower category. And again, this is where I was saying this is mainly focused and geared towards Bowser Report investors because our subscribers are fully aware that we divide our recommendations up into categories based off of how they're doing with financial results, whether or not they're performing and have a long-term sales trend that is trending upward or earnings that are trending upward over 5 years, et cetera, right? These are different things that we take into account in our rating system when we're recommending stocks, but also that we update regularly for our subscribers so that they're fully aware when a company is underperforming financially or outperforming. Okay, so just because a stock has a bump in the road or has a little hiccup here or there because they missed on earnings or there was some kind of seasonality that affected earnings does not necessarily mean that you just have to cut it loose and freak out, right? So number 3 is kind of geared towards not selling once your investment becomes a win. Number 4 is more so geared towards not panic selling. Okay, and this, for me, and again, I'm speaking from experience here as a long-term investor, for me, this has always been one of the most difficult things. Not only letting my winners ride, but also not panicking. Because especially for smaller stocks, you see a lot of hit pieces, you see a lot of short reports, and it freaks you out, right? You'll see some random person on some random website have some very bold claims against a stock that you are holding, and it'll scare you, right? A bad earnings report will scare you, but remember, these are long-term investments. So if you're really in it for the long haul, then you're not going to jump ship once there's 1 weak quarter, okay? If a dramatic number of things change for that company, the investment thesis, the reason why you started accumulating shares, then that's a problem, okay? But just because it moves to a lower category doesn't necessarily mean that you have to jump ship. All right. Now, number 5 is the heavy hitter, and this is what everybody wants to talk about, I'm sure, the selling plan. And I told you all that Max Bowser really implemented a lot of math into this, and the way you create a game plan in the first place is through trial and error. This is a fairly simple selling plan, and I'll tell you right now, I'm sure a lot of you guys have a selling plan that's similar to this, and you might not even realize it, right? The basics of this selling plan, right? And let me write it out here on the screen behind this picture. Okay, so you sell half if and when the stock doubles, right? So I'll put sell half at 100%. So if your holding goes up 100%, you would cut half of it loose, right? Sell half of your number of shares. Okay. Now, after that, you would sell sell the remainder. Okay, so the remaining half. If the stock drops 25% from its high. Okay? And then the last piece of that is that, let's say the stock moved down, because not all of your investments are going to be winners. If they are, congratulations, you're Warren Buffett. But if not, and you're a normal human being, then you would have a stock that drops and you would sell it. Sorry, sell 100%. So 1 out of 1, essentially, if we're breaking this down into fractions here, on a 50% drop. So if the stock cuts in half, you would sell it all. Okay? And you might be thinking, wow, that's very extreme. Again, we're geared towards smaller stocks. So a 50% drop is not really that uncommon for smaller companies, right? That does happen if they have a very rough couple of quarters or whatever it may be. 50% can happen in a short period of time. So this might seem like a negative. This is actually very important, because if you don't cut your losers and you're just hoping that it bounces back, your portfolio will underperform. And you guys have probably seen it in this recent stock market correction, right? So for anybody who's watching this a year out or 2 years out, it might not be as relevant, but recently, right, starting October 10th of 2018, we had a pretty deep market correction. Volatility index spiked, everybody freaked out. Major indexes dropped close to 20% across the board. And our Bowser portfolio, right, our beginner portfolio, where we essentially set up all of these rules and track our favorite stocks, outperformed, right? It wasn't green in the market correction, but it outperformed. And it's because of rules like this, where you cut the losers at 50%. Okay? Now, we're going to use an example here because there are a lot of numbers, there's a lot of math going into it. And you can kind of tell that, you might have something along these lines where a stock has doubled or done really well and you've sold it, and then it's dropped a little bit more and you've sold it a little. But we're going to go over an example here for one of our recent stock picks that, fulfilled this criteria pretty well and is a perfect example. Okay. And again, not every stock pick is going to be a perfect example, but for the sake of this video, LTRX is the one that I want to go over. So the ticker is LTRX. All right, just to give you an idea of why we initially recommended it, their technology is cutting edge, right? They have great technology, and they were presenting at a couple of conferences, starting to gain interest. And on top of all that, right, at the time it was an undervalued stock, and it had a great financial foundation built up because it's been around for a while and management knows what they're doing, right? So they just turned profitable, came back on our radar, and we recommended it back in November of 2017. Okay. Now, for those of you who are looking at this and you don't know what the heck you're looking at, this is the TD Ameritrade Thinkorswim platform, and it's just a price chart over time. You can use anything online. This is just a platform that I use regularly for my investing, but you can use anything like Yahoo Finance, FinViz, Morningstar, whatever, to track prices. But this is just how I do it regularly. So this is a candlestick chart. I probably should have a line chart up, but this is easier for me to read. And it shows each one of these candlesticks is a week, and we're looking at the past 3 years here. Okay, so we recommended LTRX in November of 2017. Now, to backtrack a little bit and tell you guys what we're talking about here, we're talking about the selling plan. So we bought initially, right, when this was recommended at 1.92. All right, and let's build up a hypothetical portfolio here, right? Let's paper trade this a little bit. Let's say that I bought 200 shares at 1.92. Okay, $1.92 per share. So that gives us, I think that's $384 of a total investment, okay, in this stock. Some of you guys might be thinking, $384, that's not much money. But the premise of our newsletter, again, is that you don't need a whole lot of money to make money and to build your wealth. Okay, so $384 in a portfolio of, let's say, 5K, right? This allows you to have 12 to 18 holdings, and you can kind of see it goes with our Bowser game plan. All right, so again, some of you might think that's a lot of money, but if you diversify, you're not really risking a whole lot in this scenario. Okay, so we have a cost basis of 200 shares at 192. That's a $384 total investment, and that was bought right here. Okay, that was bought right here where I have this green line going through. All right, at 192. So just to do the basic math right off the start, because this is how you have to do it if you have a game plan, for the stock to double, right, that would put the price up at $3.84, right? So if the price doubled, this is where I would want to sell half, 3.84 per share. Okay, so I would sell 100 of my 200 shares at 3.84 if it makes it there. Now, we're not only talking about the reward here, we're talking about the risk as well, right? Any decent investor knows that you have to calculate the risk to reward before the trade. So your reward, right, is essentially $2. For every $1 that I'm risking, I want to make $2, right? So if the stock drops, right, let's say that it drops 50%. So if this cut in half, that would put us at 96 cents per share. Okay, so in that case, we would sell 200 of the 200, so the entire position, at 96 cents if it went down. All right, and you can see I have this marked up on the chart. So this is the entry. This is where we bought it, right? Or where you would buy it if you were a subscriber, right? This is where your risk would be if it dropped 50%. And I'll put that in red so it sticks out a little bit more. Okay. And this is where your reward would be if it went up 100%. All right. Now remember, if it goes up 100%, then you essentially trail a stop, and you're saying, all right, if it pulls back 25% after doubling, then I sell the remainder. That's what happens to the other 100 shares here. Okay. Now LTRX increased in share price and went up for a variety of reasons. Right. They had a great quarter with outstanding revenue growth. They had a couple of big buyers for some of its new technology. Again, that's why we initially recommended it, and some institutional investors. So a lot of good things going for it. And in about, I think it was a year, maybe less. Yeah, so in less than a year, by August, the stock price hit 384, right? So congrats to any of you that were holding that stock and played that recommendation. It hit 384. So now that it went up 100%, we sell half. So that's minus 100 shares at 3.84. Oh, sorry, not 3.4, 3.84. All right, which leaves us with 100 shares remaining from an average, right, of 1.92. Oh, 1.92. All right, the initial entry. Now, the tricky part here, guys, is selling the remainder of the shares. And personally, this is where I get lazy, right? So if I ever say something's difficult or easy, it's usually just from my opinion, but it's different for everyone, right? So for me, after I have a winner, I get really lazy, and I also get pretty optimistic, like overly optimistic, right? I start telling my friends about it. I say, hey, check out LTRX, pretty good stock. It's been a big winner for me. But also, right, I don't really care too much about that 25% drop. You know, you have to constantly update this or put on just a trailing stop and leave it be. But bottom line is, this is where a lot of investors start to slack. Okay, I don't really know why that is. I guess we could get into the psychology behind it. But for me, cutting a winner is just as hard as cutting a loser, right? If not more difficult. So LTRX, let's zoom into this. So this is where it doubled. And this pullback, I calculated it before the webinar here, was 17%. So it did not pull back the 25% that we need to sell the remaining half. Okay. Price then shot up with another blowout quarter, and went up. And essentially how this works is you're constantly trailing a stop of 25%. So if it jumps up, you know, to $6, you would trail it 25% below $6, right? So we went all the way up to 647. That's where it ended up peaking for the time being. And from 647, 25% under that high is 4.85. So by your trailing stop or however you executed, you would have sold the remainder at 4.85. Okay, your last 100 shares at 4.85. And you can do the easy math right there, right? The proceeds from that second half are 485. Okay? And the way this works, right? Some of you guys probably have traded options or even warrants in the past. It's kind of like riding a freebie, right? You now have free shares, essentially. Once the stock doubles, the remainder of that position is free, right? So just at a glance, we can automatically see that these are the proceeds here as the stock doubled. But regardless, right, let's do the math here and let's refer back to the game plan. So we sold 100 shares. Well, actually, we bought 200 shares at 1.92. That was the first step. Okay, that gave us an initial investment of $384. All right, we sold 100 of those shares after it doubled at 3.84. All right, and that already doubled us up on the position. All right, and then we sold the remaining 100 at 4.85 per share. And again, that was another plus 485. All right. So in this case, guys, I just want to mention this because a lot of people are probably skeptical about that sell right there at 485 and will actually bash it a little bit. I think that's a great exit, and I'll tell you why. Because I personally actively trade as well. I'm a day trader. I don't just long-term invest. But the most common thing that I see from an active investor is them kicking themselves when they sell and they could have sold at a higher price. And I'll tell you one thing, if you're trying to nail the highs and lows of every investment, you will fail. That's the whole point of this game plan, is to avoid that mindset and keep a level head, right? So as you can see, this was a great winner, right? This was a great investment and we played it to the game plan and it worked out. Okay, not every investment is going to be like this, but this is a winning investment and that's an achievement. All right, so if you get in your own head and you say, well, I could have sold at $6.50, what am I doing? You're following your game plan, right? You're removing emotion from the process and you're keeping it simple. All right, so in this case, we can now move on to the next step. So remember, we talked about how for the sell plan, you sell half when it doubles and then half if it pulls off 25% from the recent high. Now that's if it were profitable. If it were not, then you would cut it all loose if it cut in half. All right, but in this case, it was profitable. So number 6 says record proceeds from sale. Okay, so in this case, well, it was sales because, you know, we had two different sales. In this case, right, we had 384 and 485. So you can see that the difference automatically is a $485 profit on the position. Okay, because these would cancel one another out. So $485 profit on that position just in total. Okay, percentage-wise, we could break that down, but we're just looking at the dollar amount now. All right, and then Bowser Game Plan rule number 7 is just very simple tracking of your portfolio. I'm sure your brokerage does it for you, or you track it in an Excel sheet. I personally, again, would highly recommend tracking it in an Excel sheet or a Google sheet, because honestly, that's where you can see if there are any human errors. You can see where you're lacking, you can see what investments did well, and you can run even more analytics on that if you want to really put some more math and effort into your game plan. Okay, so if you do track it in Excel, great. If you don't, it's not the end of the world. But regardless, your portfolio evaluation is just the current value, so 5K, right, plus the proceeds, 485, which puts you at $5,485. Okay, and you would record both of these numbers. All right, so let's run through it one last time. You do not pay more than $3 per share for a stock. That's so that you don't overpay and you can focus on stocks with more upside, all right, that have more potential exponential growth. You create a portfolio and diversify. Again, this is a sweet spot for our subscribers. This has been back tested over the years and it works like a charm, 12 to 18 stocks, but it could be different for everyone, right? This is just what we do in our newsletter. All right, do not sell. when a stock goes above $3 a share. Don't freak out when it turns into a winner and panic sell it. And definitely do not sell it when it moves to a lower category, right? There will be bumps in the road. That's a part of the investment process. Okay? The sell plan, I think personally, is the most important part of this. And that's just selling half when it doubles, sell the remainder when it drops 25% from that high. But if it cuts in half, drops 50% without doubling, sell all the shares. All right, you need to cut your losers. Even if you like the stock, cut it loose. All right, and then 6 and 7 are mainly geared towards just tracking and recording the proceeds from your sales and updating your portfolio evaluation. All right. So if you guys do have any questions, feel free to leave it in the comment section. This is a new channel, so us at the Bowser Report, we would greatly appreciate it if you liked and subscribed. We will be putting out more content, whether it's towards geared towards portfolio management or basic risk management, whatever it is, we're here to help. Okay, and again, if you are interested in subscribing to the Bowser Report, it's not like your typical stock newsletter that's going to charge you, $50 an issue. We have monthly newsletter issues that go out, and then we also have weekly and daily updates on the stock so that you could track them very closely. Right? We do all the research for you, recommend stocks once a month, and it's only $8 a month. Okay, it's under $10 at the moment. So if you're interested, feel free to subscribe on our site. And again, to everybody who is currently a subscriber of the Bowser Report, congrats on this winner from LTRX. If you aren't, you're missing out. All right. And if you do want to see other content on this channel that isn't with regards to the Bowser game plan or risk management or anything we've put out, suggest it. Right. Part of the investment process is being open-minded, and we are open-minded to any of your suggestions for more content. All right. So thank you so much, guys, for your time. Have a great day, and green screens to all of you.